Hello, good morning, good afternoon, good evening, wherever you are in the world, and welcome to Sustainability Talking Live. Where we are today, we are talking about carbon accounting through the lens of the CFO. And we're going to be asking, does carbon accounting have a branding problem? What is the CFO to do? How can sustainability people help move the gauge, as it were? And why a quest for perfect data is not necessary. And I thought before we get cracking, quickly introduce the guests. So today on the show, we have Nick Borman. Let me call your profile up, Nick. Nick Borman is a senior advisor focused on affordable corporate decarbonisation, helping industrial leaders navigate the intersection of cost, carbon, change through an FP&A driven lens. He brings more than 20 years of cross-functional leadership experience in global companies, including finance and general management, and roles at Qiagen and Agrego. How do I say that, Nick?
Qiagen and Agrego.
Okay, and today he works with companies on making decarbonisation strategies economically credible and operationally executable. Hello, Nick.
Hey, thanks. Glad to be here.
Good to have you. And also on the show today, we have Kartik. Kartik Murthy. And Kartik has spent his career spanning 16 years at the intersection of decarbonisation, ESG and strategy across Asia, Europe and North America, not just as a consultant, but from within organisations in each region. He's carried that into the practice he runs at SLC Professionals, working with industrial and consumer clients across the same geographies on GHG accounting and disclosure compliance, driving a sustainable living culture, where the SLC comes from along the way. Hello, Kartik. Good to have you on the show.
Hi, Michael and Nick, and thank you, everyone. And I hope I can add value to the conversation.
I'm sure you can. And before we get cracking, just for those who don't know, can somebody define GHG accounting? Can we just get the acronyms out of the way? Who was going to define GHG accounting for us?
Kartik, all yours.
Well, pardon, Mike. So if you look at GHG itself, it's greenhouse gases. Consists of mainly, it consists of 6 components, but the 3 main ones that are usually calculated are carbon dioxide, methane, and nitrogen dioxide. It's the gases that have been accumulated in the atmosphere, which is actually which has been scientifically proven to cause the climate change and climate warming in the atmosphere, as we have seen. Of course, there's a lot of debate over that, and specifics will always be there. But yeah, in summary, that's what greenhouse gases are.
All right. Okay. Thank you very much. I'm just going to play some music just to entertain us all, and then we get into the show. So you won't be aware of this if you're watching this on your computer, but we were all dancing away there as that music was playing. So can we get straight in there with there was a few quick fire questions just to break the ice, as it were. Does carbon accounting have a branding problem? Nick?
Well, I would say some people would say all of accounting has a branding problem. Some people consider it to be not the most exciting subject. But no, I really don't think that the branding problem itself is the big problem. The problem of greenhouse gas accounting is, look, we have invented money, and as humans, and it's not a big surprise that we have invented something that we can account of, right? Because otherwise, probably nobody would have bought that invention if we couldn't count it. Carbon, on the other hand, is not a human invention, but a physical reality. And carbon doesn't really care about how good we are in the accounting of it, right? And that is, I think, the big problem between costs and carbon. Costs are very easy to account. Well, not easy, but we have it under control to account it. On carbon, it's new and it's not that easy, and we didn't invent carbon, so now we have to deal with it.
All right, thank you. And same question for you, Kartik. Does carbon
Yeah,
count?
so I mean, great insights, Nick. I think from a measurement perspective, I think when you look at accounting as a word, carbon accounting is the branding problem specifically for carbon accounting is not evenly spread across the discipline, is what I would say. If you look at scope 1 and 2, which is emissions associated with your operations as well as with the electricity use, those you've got information that you can directly measure from real meter readings and fuel invoices, and hence the accounting of those emissions are a little bit more accurate. Where I think the word accounting becomes very diluted from a carbon accounting perspective is in scope 3 emissions, which are emissions associated with your value chain or indirect emissions. And that's where I think there's a bit of a branding problem as such, because there's a lot of information that needs to be collected, which may not be accurate initially, but would give you a lot of insights as you understand your value chain and hotspots.
All right, thank you for that. So what's the CFO to do then?
Well, I mean, I think first of all, we have in many places, many companies are now under regulation that greenhouse gas accounting has to happen, and also lots of customers of other companies that maybe are not falling under regulation are also asking what's your greenhouse gas footprint. So I think there is a compliance element that also the CFO is probably, because it is reporting, it is non-financial reporting in many jurisdictions, is probably involved in. Yeah, and so that then can mean that the finance team is also putting resources towards the same, depending on what the roles and responsibilities of a company are. So there is a compliance element where the finance function might get involved into the whole exercise. And then the second step is, of course, to have the understanding and to actually deep dive a little bit what the limitations and where we are in terms of greenhouse gas accounting. And once those limitations are maybe understood, then the big question is, of course, how could the finance function support short-term, long-term, mid-term, moving it forward to a better level of granularity, so to say.
Yeah. All right. Thank you, Nick. Kartik. So what's the CFO to do then?
So I'd say CFO would need to treat carbon accounting just the way he or she would treat any new management information system in its early days. When there's a lot of information that may not be available, you need to trust it enough to prioritize decisions, and develop it in such a way that it further increases the accuracy going forward. And this is not just a one-off exercise that needs to be done. This is a continuous exercise that needs to be taken forward. I'd also ask CFOs to include carbon in ROI calculations and return on investments and NPV and IRR calculations and project management decisions as well. All of that helps mature the systems that you need in place in order to further develop carbon accounting practices in accordance with what the CFO is actually looking for the company's long-term view.
Okay, so poor old CFO. I don't know about you. I feel a bit sorry for the CFO. What can a sustainability manager do to help the CFO along then, do you think? What difference can the sustainability people make?
Well, I think probably the most important element in my view is to understand that it is not just about decarbonization and about sustainability. It is also working within the corporate systems, right or wrong. Nothing is perfect, right? But that's where we are. We have a company, we've got a corporate system, they have lots of functions. All these functions have their ways and their ways of thinking. And we need to move decarbonization within that system practically. And therefore, sustainability is inherently an extremely cross-functional role, right? And then it is always the same for any cross-functional challenge, you need to understand your function really well, and you need to be able to explain your function. You need to understand the other function, their limitations, their ways of thinking, their history, and then we need to find something together to move forward that is acceptable for both functions. And that requires a very deep conversation, and that then requires maybe a non-dogmatic conversation that then really means, hey, we are where we are. How can we move forward together? The world is not perfect, and the clock is ticking, and we don't have so much time. So it's a huge challenge, but it's definitely a cross-functional challenge, and embracing that, I think, is the number one factor, in my view. Kartik.
Yeah.
Okay.
And Nick, to add to that, I think that's a very valid point that you're talking about, saying that sustainability is a cross-functional discipline. And I think sustainability managers and leaders can equip themselves by trying to speak finances language back to them and try to integrate sustainability into the finance lingo as well, which is where I think conversations between finance and sustainability need to happen at a very early stage, so that they can understand each other's point of view and try to make sure that the long-term goal of advancing the company's goals is met.
All right, so I want to talk to you a little bit about perfection. I made the mistake of trying to Google the name of that song. You've got to be perfect, but I can't find. Well, I could find it, but I can't just double check I got the right song when we're broadcasting live. I think it was Fairground Attraction. But anyway, perfection, Nick. You feel that we don't. The quest for perfect data isn't necessary. You can't hold back a sustainability which is waiting for everything to be perfect. Can you expand upon that?
Yeah, well, I think the quest for perfect data is necessary. It will just probably take us, I don't know, at least 10 years or more, I guess. Let's say just decades potentially. Let's see. And that then means, or that then poses the obvious question: if we do not have perfect data right now, what does that mean? Do we like all pack up and say, okay, well, we'll wait for it, and then we will come back to the topic, or do we have to somehow move forward even if we don't have perfect data? And of course, in business, okay, perfect data doesn't exist, right? But we have very, very, very good data to make decisions on in many aspects and in many functions, right? I mean, finance is creating a lot of financial data to make decisions on. We've got non-financial KPIs; they're all good, and that is then where I think sustainability or decarbonization has a special burden and a special problem, because our data is not that good, maybe, or has some.
All right, okay. Thank you. Anything to add to that, Kartik?
I just say don't let perfection get in the way of progress. I think what's more important is to make sure that the company progresses in its long-term goals. It's taken financial accounting space, I think close to, I think Nick, you would have a better number, but I think since the Depression, it's been working, the grand old days of the Great Depression, that it's been working on developing its systems and processes. Sustainability hasn't had that much time to work on it. So I just say that's the only quote that I would say. Don't let perfection get in the way of progress.
It's a bit early then. We need a bit more time to get
We
it
need
right.
a bit more time, but it should still help you use the existing information to get business decisions done.
Okay, now we've had a few questions. Can we deal with those questions before we move on? Are you happy to do that?
Sure.
So, well, this isn't a question. Very interesting topic. Thank you, Leah. Manoj, how do you build a business case for carbon initiatives when ROI isn't immediately clear? Now, I'm sure we're going to be going into that in a little bit, but can you have a stab at answering that question? Either of you? Both of you? Neither of you?
Patrick, do you want to go ahead, or?
Yeah, so I mean, I can take a stab at this. It depends on the kinds of carbon initiatives. There are a few of them where ROIs are already are clear, and you can actually include them into your calculations. In certain other cases, I think there's the need for understanding the long-term view, and making sure that the CFO also understands that while this is an investment that needs to be made at this point in time, there's there's going to be some time and time that will take for certain initiatives to come through. And this is where the conversation between the CFO and the sustainability teams and the longer strategy of the organization would make sense. There would be some cases where certain projects may not go ahead because the ROI isn't immediately clear, and that's fine. And that's where when a lot more of these initiatives come through and innovation does make the ROI case clear, then those projects can then come through. But there are already certain cases, like for instance, renewable energy initiatives, where the ROI case is clear, and those can be brought forward as quickly as possible. I think that's going to be more important. The conversations that you have with the CFO to make sure that they work together to make the case clear.
Okay. Nick, anything to add to that?
Yeah, I mean, to build on Kartik's point, I mean, luckily, at least for some technology like renewable energy, most likely we are in the luxurious position where costs and carbon go in the same direction. So something has a positive ROI from a cost point of view and is also good for carbon, right? Those are the blessed areas where we don't need to worry that maybe greenhouse gas accounting is a little bit difficult. We can just build the business case on costs, right? And those are then the no regret moves, but we'll surely talk about them a lot more. But I think this question is also where that this question or this challenge can run against the problems in greenhouse gas accounting, right? Because and we'll talk about it, but that is really one of the limitations. But I think before that, like forgetting all the numbers, two things should be clear before we even go into any business case calculation. What is the real risk and opportunities of decarbonization? And I don't mean a tick the box risk exercise. I mean real soul searching, right? Double materiality and this kind of stuff, right? There's also legislation that kind of wants companies to do risk assessment. Don't do it as a tick the box exercise. What does it really mean over the next years? And once you have that picture, then of course the next thing is to have that deep conversation within a company. Why do we want to do decarbonization? Why do we really do it? Do we do it to comply with regulation? Is it more than that? What is it actually based on the risk and opportunities? And once you have those two pillars, then maybe it is also easier to build a business case, because then you can hook it onto these previous discussions, even if you don't have the perfect data and everything that you need.
Yeah, and
all right,
just adding to that, I think that's a process that takes time and effort, and it needs the involvement of all the teams right from the get-go.
Okay, thank you. Yeah, I've got something to add to that myself. I mean, I do think there's a parallel between sustainability and a disruptive technology. I mean, sustainability isn't a technology as such, but I do think that it's analogous to that. And the corporate graveyards are full of organizations that said, we don't need to worry about this disruptive technology. And I feel that there will be a similar pattern will emerge for organizations that do dismiss sustainability at this stage. Manoj, is another question as well. How can finance teams improve the accuracy of Scope 3 emissions data without creating excessive reporting overheads? That's practically a show in its own right, isn't it, I think? So can you give that a very short answer? Who wants to go first? Nick, can you go first on that?
Yeah, I think that is exactly the big challenge, right? And the big challenge here is, I mean, first of all, step one is doing something a little bit better than the absolute basic, and the absolute basic is of course spend-based Scope 3 accounting for many companies, but whenever you do that, right, you will need insights. You will need to probably work with your suppliers. You need, in what shape or form, right? You need to go one level of granularity. So therefore, the very first thing that I would advise is go involve the procurement organization, the supply chain organization of the company, and establish the need for action and establish the working together, and then see what can make sense for the company, how quickly can you move into something better. But it is nothing that a company can necessarily fix all by itself. it will require a supply chain approach, and that is where the challenge starts.
All right, thanks, Nick.
Yeah, so I like Nick said, I think this is a maturity cycle that will take time and effort. I think using spend-based data is probably the best way, especially for Scope 3 emissions, to move forward. Use that information to identify areas in which you can actually work with your value chain to then try and improve collection of data over a period of time. And then again, like I said, the maturity cycle will take a lot of time and effort, but that is probably the way I would start off doing it.
All right, thank you. Hello, Karen. Thank you. Thank you for your comment. And another question from Manoj. This is 3 questions. He's gone for the hat trick. Beyond compliance, how can CFOs use carbon accounting to make better capital allocation and operational decisions? You're giving us lots of ammunition to do future shows here, Manoj. Can I ask you in a different order? Would you be interested in would you like to go first this time, Kartik, on this?
Yeah, sure, definitely. So I think first of all, CFOs need to start including carbon accounting within their the return on investment calculations. There are a lot of cases where go no-go decisions can be taken immediately. One example that comes to my mind is in the steel industry, specifically with the shift from blast furnaces to electric arc furnaces. By just adding the cost of carbon to the return on investment calculations can actually help strengthen the case for major capital investments that can be made in this particular case. I'm sure there would be other areas also that would be there that this would come into the picture. But I think start including carbon into the ROI calculations, and also look at innovative ways of getting things in place. I think with things like the carbon border adjustment mechanism, there's directly a cost per carbon that's already associated with the products, and that incentivizes you to include things like product carbon footprints into your calculations for the kinds of products decisions on the kinds of products that you want to actually import into the EU. I know that this is something specific to the EU, but there's a lot of ways in which you can actually include that information as well. So there are things that are happening that are making CFOs starting to look at including the cost of carbon into their ROI calculations.
All right, thank you. Nick?
Yeah, exactly. I mean, as you said, Kartik, the only thing I would add is do not get confused when investment level carbon accounting numbers don't reconcile on a one-to-one basis with your emission statement that you publish to the outside, right? That is, I mean, that to a degree sometimes can also be a problem on the cost side, but in the carbon side, on the carbon side, it can be really a complete disconnect, because if you do spend-based accounting on your external emission statement on many line items, and then you take a decision on a supplier or something, do we switch supplier? Do we not switch supplier? That is very specific and manually calculated. A return on investment, right? Then there can be a disconnect between your capital allocation or operational decision number and your emission statement number, and that is currently where we are at, and that we need to manage this complexity.
All right, thank you, Nick. Another question, an observation from Krishna. Krishna is appearing on the show in a few weeks' time. The synergies between sustainability and finance certainly is a deal maker for the board.
I couldn't agree more, because there's a lot of overlap where actually finance and sustainability are and should be best friends. Like I, in my corporate career, at certain stages, when business was tough, the financial controller then sometimes asks the team to maybe reduce travel expenses, right? Now, what would happen if the chief sustainability officer, together with the with the chief financial officer, both ask for a little bit careful travel, more zoom, because that would be good for costs and good for carbon. And therefore, if you think through where is this zone of overlap, where are both functions totally aligned, if you really think about it, the zone is actually bigger than you would first imagine. So yes, we should be best friends.
All right, thank you. And hello, Eric from France. Eric is dialing in from the south of France. And Eric, you might be interested to know that living in the south of France, you've got something in common with Mbappe, your football player, which is Mbappe has a top speed of 37.5 kilometers, which by sheer coincidence per hour, matches the temperature in the south of France the other day, which is 37.5 degrees centigrade. I thought you might be interested in that. We could get onto the show now. Running a little late, but that's okay because it was important to ask those questions. So Nick, can you explain the finance perspective and the initial pain points?
Yeah, so look, I mean, the topic of climate and emissions really hit my finance desk in my last corporate role around 3.5 years ago, right? Before that, I thought I was supportive. I thought I knew a thing or two, and then I found out I know very little in reality, and then I started down the rabbit hole, so to say. But what really struck me, first of all, is that there is a lot of overlap. There's so much similarity between cost and carbon, next to both words starting with a C, right? The world of costs and carbon has a lot of parallels, right? And one parallel is, of course, you've got this beautiful emission statement that companies publish, and that emission statement has line items, right? Scope 1, Scope 2, lots of Scope 3 line items, like a financial statement. And it has columns, like years, and then there are like targets in some cases, or in many cases. And of course, that's what we have in finance, right? I mean, give me a P&L, give me some actual numbers. And as a financial controller, I know exactly what to do to create the next year's budget with the management, of course, not alone. Create a 3-year plan, create a 5-year plan to improve cost areas, right? And that is exactly what we are looking for in corporate decarbonization. Take the actual emission statement, take the actual footprint of a company, and then find ways to improve it. Also called the climate transition plan. Also now more and more bodies ask for it. So my first view was, okay, this is very familiar, right? We can do this. It works on very similar principles. And then, of course, the second step is, if you are new in any finance role or in any organization, well, understand where the actuals come from. Understand what the actuals mean, right? Because if you don't understand the actuals, then the financial actuals, then you cannot come up with plans together with management to improve them. So when you start understanding the greenhouse gas accounting actuals in the same way that you would understand the financial actuals, what you find is, or what I found is, and that is, I believe, usual for many organizations, that there is a lot of stuff that is calculated based on spend-based accounting, where you take supply, and you spend money, and then you apply a pretty generic industry standard emission factor to that dollar of spent, and then that is your actuals. Well, then it immediately struck me how difficult this is for making plans to reduce it, because if that's the rule, then you have immediately, and that comes back to your question, Manoj, why is it so difficult to create a return on investment? You have two really difficult things to get your head around. You can have real life impacts, like a supplier is decarbonizing. You have the best supplier in the world. They're doing amazing stuff, but because you're doing spend-based accounting and they don't change the general industry emission factor that you apply to their spend, whatever they do in real life does not have an impact on the company's emission statement. Right? Because there's no connection, no direct cause and effect connection. And so if you spend more money with that supplier, or if you accept a price increase of that supplier because the green products are really green and the price increase is very moderate, you don't improve your emission statement. On the other hand, you can have emission statement impacts because your emission factors are getting updated once a year maybe, and then they improve. but your supplier didn't improve. On the contrary, maybe you have the worst supplier in the world, and they just went to a sales conference in Fiji, and everybody flew to Fiji, right? And they blew a lot of carbon, but it doesn't matter to your emission statement. So real life impact versus the emission statement, right? Emission statement can improve, real life impact can not improve. And now do a return on investment calculation. Like if somebody asks, okay, give me $500,000 to improve the emission statement, and I want to invest it, I want to switch suppliers, right? It will cost us one-off $500,000, but then the emission statement doesn't improve. So I have nothing to show for it in the outside. And that is the fundamental issue that really felt, I don't want to say like a shock, but that is where I felt that it is a really, really, really big challenge, and I got kind of hooked on it. But that was really my experience, and I think Kartik, I'm probably not completely alone in having this experience, right?
Yeah, Nick, I think it's and that's a great analogy you just put in there, talking about suddenly asking for a lot of money to improve your carbon emission statement, which is where I think if you look at spend-based accounting, I think it's, and this is specific to scope 3 emissions. Spend-based accounting is necessary for your initial hotspot analysis. The idea being where you actually spend a lot of your money, with who you spend that money with, is the relationships with whom you would have sort of a larger amount of trade with, and as a result, a larger amount of emissions associated with them. But I think the long-term goal is, and this is my opinion, is that spend-based accounting should only be used for understanding what kinds of strategies you want to set with your value chain. The end-term goal will always be to ensure that you have better accounting systems to capture that information, capture the actual emissions information from your suppliers. So a couple of things that comes in here. When you talk of big suppliers that are doing a lot of stuff and in their sense, but that's not reflecting on your operations, chances are that you would have a good working relationship with those suppliers in the first place. One, because you have a large amount of spend with them. That means they are large, sort of, they are a large, for you, they are a large, I mean, for you are a large customer for them. And second, they are willing to actually, chances are that they'll be willing to work with you to make sure that the results of their carbon reduction initiatives are reflective on your statement as well. So what I would do in such a case, and this is where you need to look at procurement strategies, work with your procurement teams to understand the relationships that you have with your value chain, and develop strategies to see how you will work with them to ensure that the right information and more accurate information falls on your scope 3 accounting statement to deliver the net zero goals or whatever it is that you have set as part of your long-term strategy. There may also be cases where, in some cases, if, like you said, there may be a supplier that's not doing anything. You might want to even use carbon accounting as a reason to sever relationships with them if they do not try and improve their accounting or their emissions profile going forward. So there are strategies that actually can be brought in place. And then again, that is why I say spend accounting is something that you will initially use for the first few years. And this is also reflective in a lot of the regulations that are coming in. There's a lot of flexibility in terms of making sure your scope 3 accounting is in place that is reflective of the complexity involved in calculating these emissions. But the longer term goal is for you to develop those better relationships and strategies with your value chain to ensure how you can get the right information to showcase the effect of the work that you've done in reducing emissions across your value chain.
Yeah, no, absolutely. And I think one of the challenges I also see is like some suppliers even are like very advanced, right? They do product carbon footprint data. They want their customers to have better data, and other companies are, just not so interested maybe, and are actively pushing back. And of course, we have different opinions on climate and climate change in different jurisdictions of the world. So how do you what's in your view, how should companies handle that diversity of suppliers, where some are top of the class product carbon footprint, the other ones are saying, it's really not relevant at the moment. How do you then create your emission statement with this kind of mix, and how does it evolve? What could we do?
That's an interesting point. It certainly depends on the jurisdiction that you're at. If you are in the EU, for example, you have a direct cost associated with a product carbon footprint that you can actually just slap it onto your value chain if needed, because of the carbon border adjustment mechanism and those mechanisms that are already in place. You can always use that as a way to help your value chain improve, or even get into creating product carbon footprints in the first place. In regions where probably you do not have those things in place, I think it's important for you to use your spend-based accounting to I normally do an 80-20 analysis, where 80% of your spend would be with 20% of your vendors. Those would be your largest sort of suppliers that you would want to work with, and then try and understand from them, based on the relationships that procurement has with them, how willing they are to actually develop things in place. If we are going for scope 3 accounting, that means that we already have a good enough understanding of the practices that we need. We can always share those practices with those who are willing to work with us and take things forward. So I would say having that procurement strategy in place in terms of, okay, who is willing to work with me, who is big enough to work with me, for whom is it going to be important, and who do we actually just let go, that is going to help ensure that there are more stringent practices within carbon accounting for scope 3 that happens beyond just spend-based accounting in the long run.
No, definitely. I mean, it feels to me like procurement is really, really important. That's what you are saying, and I think that's totally spot on. I think we should start calling procurement the climate department, maybe, given their big impact for all companies that are heavily where scope 3 is the predominant part, and many companies have 90% or more scope 3 emissions, right? So, and I mean, what really struck me then is the next step, realizing how that the emission statement of a company right now is not necessarily a decision making tool or a decision basis, right? I can do a lot of decisions based on the data of a financial statement of a company, right? And I can link them into Manoj's question. I can link then the ROI directly, and I can do very good ROI perspectives and promises to management, and we can have real trade-off decisions. With a predominantly spend-based emission statement, that's more difficult. So then the next question, or the third question that was big in my mind, is, okay, how do we still move in the next years, while hopefully greenhouse gas accounting is evolving and getting better every year? How do we move forward despite not having the perfect data? So I was like thinking about it. Okay, what would I do because I also spent 5 years in general management, right? I was then imagining, okay, how would I have run that business if controlling and accounting and the finance department would have said, hey, we are all sick with whatever, COVID, we'll get better. We're all vaccinated, but we are all out now, and I still need to move forward, right? So I don't have all the data I'm used to, but I could still run my business, right? I mean, accounting, there was a way to run businesses, not right now, but we had business before we had accounting. Accounting is 500 years old, the current form of it. So how do you see that? Like, what is your thinking about how to manage, even if we don't have all the data we would normally have in other functions?
Yeah, so I think that's a problem that every CFO getting into this would face in the initial few days. I would look at it from 2 points of view. One is, look at quick wins. First of all, there are already places where you can actually use carbon information to further enhance your ROI calculations, especially in scope 1 and 2 accounting. And a lot of projects that are either, I mean, the ROIs could come through, the return on investments could come through operational efficiencies or increases in revenues. If there's an operational efficiency factor to it, a carbon-based information can actually enhance the outcome of that, because by reducing, say, electricity use, you're actually reducing the carbon footprint as well as a result. So there are these calculations that need to be that can be added as well, which I think needs to go into every net present value or internal rate of return calculation for any CFO making a decision on any project going forward. So those are the quick wins where I think you'll then first start to understand as a finance team that okay, there is an effect of carbon reduction because of some of the projects that we are actually doing in place at this point in time. The place where this gets a little bit more murkier is in scope 3 emissions, because a couple of things. One is scope 3 emissions for most organizations would end up being the largest footprint. And second, these have got to do with projects that are not under your control. These are actually with your value chain. So it's actually in projects um, outside of your jurisdiction. So they're not exactly revenue generating. So they're actually cost creating in that sense, which is why I think spend based factors first make sense to do an analysis to understand where your spends are happening and where your costs are incurring at this point in time. And the effect over the longer period of run will be to make sure that your spends are also aligned with the carbon management processes of your value chain going forward. So, and then, like I mentioned earlier, we shouldn't let perfection get in the way of progress. I think progress is what's most important. If you have a long-term strategy of achieving a net zero goal in the long period of run, I wouldn't stick on to making sure that we have the perfect data and spend 10 years trying to get that. I would rather use the existing spend data, make informed decisions, and try to see how I can improve the data over a period of time and use that information to make certain investment decisions for the company going forward.
Yeah. No, absolutely. Yeah. I mean, overall, it seems like we have our work cut out for us for sure.
Very much so. Yeah, I would agree with that.
Perfect.
Okay, Guy, thank you for that. We've had a couple more questions whilst you were chatting. Eric, creating access to green finance by adopting pertinent technological solutions through carbon accounting comparison is a path of possible interest for a CFO. I think that's more of an observation than a question, but I don't know if either of you want to come in on that.
Yeah, I mean, definitely. I think there are many incentives, right? All kinds of incentives to get carbon accounting better, to get better granularity. Kartik, you mentioned CBAM, for example, right, in the EU. So definitely, I mean, there is a case to be made, of course, and there are incentives to move forward in the right direction beyond just, doing good.
I think there are also additional funding sources that can come in for specific types of projects. Especially when you're talking about technological solutions, there's quite a bit of waste to energy based funding that's there across the pond in Canada and in other regions as well. And I think those are additional funding streams that can add sort of improvements to your return on investment calculations from a CFO lens.
Okay, thank you. And we've got more questions, but before I do, just say hello to Kenya. Nice when people log in from all over the world. Nice to have you here, Lorraine. The next question is from Bhavani. What hurdle rate or internal rate of return, IRR, adjustments would financial planning be willing to consider for transition assets that cover traditional strategy on the decarbonisation strategy against future carbon taxes and volatile energy markets? Do you have any comments about that question? Have you got any thoughts about that?
Well, I mean, of course, highly company specific, but I would go back to, first of all, risk and opportunity analysis, right? That is the basis. It's not a tick the box exercise. It needs to be really, really good. And then that might provide you a lot of answers also for this important question.
Okay. Eric, lots of suppliers are refusing to share their products' carbon footprint prior to being under contract, which make the comparison between suppliers ex ante difficult. I don't know if you have any observations about that, or maybe just a nod. I don't know.
I think it's and that's a very valid observation that that's raised. it's part and parcel of trying to work with your supply chain, and that's where to ensure that the information is in place. So if the strategy that you've set with this particular supplier is that if they don't provide this information, you sever relationships with them, then so be it. That's where I think getting your vendor relationship strategy in place based on the spend amounts that you've had with those with the based on the spend based accounting that you do will makes a lot of sense, because it helps establish the kinds of relationships that you want with your suppliers, and the kinds of long-term relationships that you want with them as well going forward.
Okay, and we've actually had an answer to Eric's question on the comments. So Eric asked, lots of suppliers are refusing to share their product carbon footprint prior to being under contract, which makes it difficult for the comparison between suppliers. And Ross asked, I applied. The USA government assigns NAIC code to every tactical product, service, etc. in a hierarchy system. Assigning CF tags to those would allow overall carbon footprint products and service summaries to be aggregated into finished goods summaries as well. And we have another question.
That's an interesting point that he raised. I think what's more important, I think, is to understand why they are not agreeing to provide the data in the first place. And that's where you have relationships with your suppliers, you'll know how open they are to actually sharing the information, and thus your strategies would then move forward accordingly.
Okay, and then we have a question from Lorraine in Kenya. Great insights, thank you. How do you avoid double accounting of your organization's Scope 1 being repeated under another organization's Scope 3?
I need to take this one. This is my favorite. Because in the world of costs, we are double counting. If we three are running a business, my costs I translate into a price. I'm charging that to you, Kartik, and you are reporting the costs my costs in your statement again. Then you sell it to Michael. You are reporting it. So if we are three independent organizations, if you sum up our financial statements, you see the costs of the same item 3 times, including markups. If we now decide that we become one company and we report to the outside, then the costs appear once and the rest is intercompany consolidated between our 3 entities. So in the world of costs, we are double counting if we sum up all these entities. Why wouldn't we in the world of carbon? It is the smartest move. It is the best to do exactly the same in this regard than we do in finance. It is because that creates a huge incentive to improve. And that is how finance works. And the world of carbon should do exactly here. Don't worry about double counting. It's exactly right. We do it in finance. Let's do it in emission statements and in decarbonization as well.
And that goes again to the point that Scope 3 emissions have got to do with boundaries outside of your operational boundary, where Scope 1 and 2 is within your boundary. So Nick, in your example, you talked about companies being outside the company boundary, so they're being sort of copying of the same numbers over there. I think that's the same thing that you'll see with Scope 1 and 3 as well.
Yeah.
Okay. Do you have a comment on this question?
Yeah, absolutely. We can and we should, right? In the end, what is the perfect solution to greenhouse gas accounting? Look, in manufacturing, when you manufacture a product, you are going to have a bill of material in your finance system, ERP, enterprise resource planning system. There's going to be a bill of material. You manufacture a product, it has, 200 components. For each component in the system, I'm going to have a cost. Okay? Because if I don't, I cannot evaluate my inventory value at the end of production. I don't know what the inventory value of what I have just produced is. And if I don't know that, then I can't do my financial statements and all the auditors will be on top of me. So the end is very simple. Give me a second column in my ERP system next to the costs for each of those 200 items I need to manufacture this pen, and just put me the carbon next to it. Next to the costs, put the carbon, the product carbon footprint of that material. And if, of course, then we would all do that, and it's going to be terribly complicated and burdensome, but so is cost accounting, then we would have very, very, very good carbon accounting all of a sudden. And that comes down to what, Eric, you just pointed out, product carbon footprint as a tender KPI next to the price. And if some supplier doesn't want to tell me the product carbon footprint, well, funny, because they tell me the costs of the product, right? I mean, even if they're not under contract, they will tell me the costs in finance. So why exactly would they not tell me the carbon costs of that product? Like what's the problem, right?
I'd add that specifically for EU companies, I think this has become more pertinent, especially with carbon accounting mechanisms that are in place for products coming into the EU and also being sold within the EU. So the general case will be, if you do not add this, then we'll be adding a price per carbon for each product that you actually put in, and that will affect your pricing that you put in place in the first place. So I think the incentive is there to do carbon footprints, PCFs. Yep.
Absolutely.
All right. So what I thought we'd do, we really need to pack up now, is I'm going to give you a kind of a 3-point summary of some of the key points, and then I'm going to give you both 1 minute to say whatever you want to say, but just whatever you think is important, that the lesson people want to take home. So if I could just quickly summarize, sustainability accounting is still maturing, just as financial accounting took centuries and decades to mature. Point 1. Companies continuously improve the quality of their emissions accounting, but most importantly, organizations do not need perfect data before they start taking meaningful decarbonisation action. Now, can I give you both 1 minute each to say your killer points? You're leaving in the elevator. The CEO's in the elevator with you. Oh, what do you think the most important thing I should take home from today's session is? Okay, Nick, go. You've got 1 minute.
Yeah, I mean, first of all, step 1, let's get together with procurement. Let's make a strategy how to work with our suppliers and with finance to create a roadmap for better greenhouse gas accounting, and of course also all the other line items. And number 2, let's realize just how big the alignment zone is between sustainability team and the finance team, because there are many no regret moves. There are many moves we can take over the next years that are both good for costs and carbon. And while we are figuring out so many things in our overall system, like greenhouse gas accounting, for the next 5 years, we can all be terribly busy implementing things that are good for costs and carbon, electrification, making sure that the travel is balanced between online sessions and real life travel, and so much more. Thank you.
Okay, thank you, Nick. And last words to you, Kartik.
Yeah, so I would say from a CFO's point of view, I agree with what Nick said first. I think getting everyone involved on the table from the get-go is important. For Scope 3 specifically, procurement teams and sustainability teams across, you need to get your operations involved when you're looking at Scope 1 and 2 emissions. So this is a team exercise. Quick wins can come in from Scope 1 and 2 emissions, and then use that to then sort of develop further cases for further complicated projects that might come down the line. And for Scope 3 accounting, I would say use spend-based accounting for your hotspots analysis to understand where you can affect the largest change in your value chain, and then develop strategies to make sure that that your value chain then works with you to help reduce not just your emissions in the value chain, but also their emissions through their operations. So there's a win-win that can always be achieved over there as well.
Okay, well, thank you very much indeed. Thank you for watching this at home on your computers, wherever you are in the world. And next week, we're doing Protecting Nature. Whose job is it anyway? And I'm not going to be hosting that. That's going to be hosted by Sue Bonney, former head of ESG at KPMG. So that's I'll be taking a bit of a back seat next week. But thank you very much, Nick and Kartik. And thank you for watching.
Super. Thanks, everybody.
Thank you, everyone.
Thanks. Great discussion.